Hey everybody, and welcome back to another video. This is how to invest. I wanted to start this off by saying if you like the content, please like and definitely subscribe. It helps the channel grow a lot. And let's hop right into it. This video is on a SPAC, which has gotten a lot of negative publicity in the past couple weeks. But I think with all cases, you can't broadly judge a group of things. You have to look at the individuals, and this is no different with stocks. So let's get into ACIC, or Atlas Crest Investment Corp. They are currently at $10.01, but as we know here, the market capitalization is much more important, and they are only $625 million. So for most SPACs, if you're unaware, there is a floor price around $10. This is because they are blank check companies and they have no underlying business. So people don't really know how to value that, so they say, all right, let's just cut the crap. We'll value it $10. If you want to buy in, buy in. If you don't, don't. A lot of SPACs are based off of hype, so people will buy in based off of merger news or merger, like even just anticipation of a merger. The merger doesn't even have to have a confirmation, and this could double or triple. But the price floor is usually set at $10. The only exception I have ever seen to this is Bill Ackman's. He runs Perishing Square, and they went public at $22, which was a weird price floor, but that was based off of his reputation as an investor and just the name alone. So without further ado, let's get into some of the numbers behind this. Like I said, there's a $6.25 million market capitalization. If we look at some of the statistics, there is 49% held by institutions. I know ARK Invest was a big investor in this company, but I never like to buy something based off of another famous investor buying them. I think that is kind of blindly following like sheep. I always like to do my own research and have my own opinions based off of the numbers. Just like anything in the world, I would want my own opinion. I don't want to just think what other people think. We all have our own minds. We might as well use them. The one bearish thing I was looking here was that the percent held by insiders is 0. This is never a good sign, just because if a company is held by a lot of their workers, they are more inclined to work harder and just trying to improve the company on a day-to-day basis. Another thing I want to get into, which was the last, because there's not much to see here, because this is not the merger company, this is just the blank check company, so you can't really get much of an idea of what this company is doing, just because this isn't the real company yet. And the company that you will be buying if you buy this stock currently is yet to be gone public. They will go public and merge sometime in Q2 of 2021, which is this year and this quarter. Obviously, Q2 just started in the beginning of April, so sometime in the next 3 months they will merge, and they will go under the ticker symbol AC or ARCH, or for Archer. So the short position is getting quite high. Where I start to look at where a short position is noticeable is above 5%. You start to say, whoa, there's a good amount of people shorting this stock. Upwards of 10 is when you start to think, oh, there's an actual good amount of short interest here, and it's getting pretty high. And then above 20 would be very, very high. So anything above that would be abnormal. If we look here, it is 7, almost 8, which I don't mind. I think a lot of people are doing this to, one, help buy more stock. They are keeping the price naturally low for the short period to be able to buy more at a good price, since the price floor is set in at $10. If we look at a monthly chart, it has just kind of had a couple spikes above around 10.20 and then going back to 10, 10.20, back down to 10. So people are taking some profits up here and then selling, buying back more, just based off shorts making money here. But I have no problem with this. This helps you buy more stock over the long period of time, and just helps you get a bigger position and will help you make more money in the company over the long run. So we have here an article that is on the company that they will be merging with. The company is Archer, as I said before. and the headline is Archer lands $1 billion order from United Airlines, which is a very big company. And kind of surprised United has $1 billion to be spending considering airlines currently. But if we get into the article, one of the first things that it says is when they merge, it will have an equity valuation of $3.8 billion, which is already, if we look here at the market cap, 5x of the current price. So a 5x on the market capitalization roughly would lead to a $50 stock price, which is insane. So if this thing could 5x within 3 months, within this quarter, that would be one of my biggest home runs in a while. I can't recall the last time I've had a 5x within 3 months, but I think the only thing that's come close to that is Playboy stock has had basically a 4x in a month or two. But if we look here, that is not always going to be the case. Stock market valuations don't always go equal to the stock price. They are separate. But if we look here, the company is also to have $1.1 billion in gross proceeds, including $600 million in PIPE investments. Some of these investors include United Airlines, as stated before, Stellantis, Exor, Baron Capital, who was an early investor into Tesla, who made a lot of money, Kaufman Funds, and others. And further into the article, they say they have $500 million in cash trust. So they already have $500 million on their balance sheet, which is great to hear. Anytime you're able to have almost the entire amount in your market capitalization as in cash, you're looking pretty good balance sheet. And prior to this SPAC, they had raised $60 million. So they have $560 million, and this company is worth $625 million. They basically have all the cash that they're worth already, which is probably the most bullish thing I've ever seen in a company. That balance sheet is unreal. Separately, Palo Alto has confirmed that United Airlines has agreed to invest in the company, not only be a PIPE investor, but be a customer. They have already placed $1 billion order and have an option to buy $500 million more. So they have $1 billion in revenue already and the potential of $1.5 billion. And the company is worth less than half of that. If we go from $625 million to $1.5 billion, that's a 1.5% increase, which is huge. Archer has yet to mass electric vehicle takeoff and is designed 60 mile on a single charge at 150 miles an hour. Now, a lot of people are complaining that this isn't very far, but these are meant for urban areas and cities, which have a radius or a circumference of maybe max 50 miles. So you're never really going more than this without charging it. So I don't really think anything more than that is feasible right now. Obviously, as batteries get better and electronic vehicles really scale up, this will be much more, and you can take it long distance. But I think that is a little bit further into the future. And even Archer might not even be a player in that field. They might be more based in the local, city-based ones, because this is still a very, very new technology. Here in the article, it kind of gets more into what they are about, but we have already gone over all the important information, in my opinion. So if we look here, we can actually take what their sales is from that article and base it off of some info here. So because this is just the SPAC company or the blank check, they don't have any financials since they're not really making any money right now, but we can do some investigation, which we just did, to find out some of these numbers. And one that I'm going to do is the price to sales, considering that they are not earning any money on the bottom line yet because they only have revenue. But you can do price to sales with revenue because you do not need to make money on the bottom line to get that number. So if we look here, average price to sales is 1.55 from March 12th, 2021, and the low was 0.8 in March 2009, so over a decade ago. If we do the numbers, their sales was $1 billion. If we do 600 million, their market capitalization for price. And if we divide that by their sales, which was $1 billion, you get 0.6, which is lower than the average from over a decade on the S&P 500. Now, this isn't going to be on the S&P 500. This is going just to be on the New York Stock Exchange, and it might eventually be on the NASDAQ if it gets big enough. But 0.6 price to sales, and that's not even including the additional $500 million that they could get. If they include that, their price to sales goes way lower. And with all of these statistic metrics that we're looking at based off of value, the lower is the better. Trailing P, the lower the better. Forward P, the lower the better. PEG ratio, the lower the better. Price to sales, price to book, the lower the better. So if it's a 0.6 or under, that is a screaming buy to me, including the price floor at $10, which we're a penny above, and including the deals that they already have with United Airlines. So everything about this stock is screaming buy, buy, buy. The one thing that I will say, this company is not expected to make any vehicles until 2023. So they are not very, they don't have very much revenue. They only have the one deal so far. But I think just currently looking at the capitalization based off of their orders already, I think that this is an undervalued SPAC. Now, that is a kind of almost a contradiction, people might say, or even a contradiction right now, undervalued SPAC, because most people believe SPACs are overpriced. But like I said earlier, I think you have to look at each individual one on an individual case basis. So definitely do some more research into this, and if you like the video, please like and subscribe, and come again.